Here's something that surprises a lot of people. Multiple studies on investor behavior have found that the average investor earns meaningfully less than the very funds they're invested in. Same fund, same underlying returns, but investors, as a group, capture less of it. Today we're breaking down 5 behaviors that explain why and how to spot them in yourself before they cost you. Whether you're investing through a 401k, an IRA, or a regular brokerage account, these patterns show up the same way. Let's start with panic selling. When markets drop sharply, most investors feel the pain of losing money more intensely than the pleasure of an equivalent gain. Behavioral economists call this loss aversion, and it's one of the most well-documented biases in finance. The problem is what it leads people to do. When a portfolio drops 20 or 30%, the emotional pressure to stop the bleeding and sell can be overwhelming. But market recoveries tend to be uneven and fast. A meaningful chunk of the market's best days historically cluster right around its worst days. Investors who sell during the downturn often aren't back in the market yet when the recovery happens, and missing even a handful of the strongest days can meaningfully lower long-term returns. One common antidote is having a plan for downturns before they happen, so you're not deciding under pressure. Next is overconcentration. This shows up in a few common ways. Sometimes it's overconfidence in one company or sector after a run of good performance. Other times it's something more personal, like an employee holding a large amount of company stock because it's familiar and convenient. The risk here isn't just that one investment could underperform, it's correlated risk. If you work at a company and also hold a large chunk of your portfolio in that same company's stock, a downturn at that company can hit your investments and your paycheck at the same time. Diversification exists specifically to reduce this kind of single point of failure risk. A common guideline some investors use is capping any single stock position at a small percentage of the total portfolio. Third is performance chasing, sometimes called herd behavior. This one is rooted in recency bias, our tendency to overweight what happened recently and assume it will keep happening. When an asset or sector has had a strong run, money tends to flood in near the top after most of the gains have already happened. Then, when performance cools off or reverses, that same money often exits near the bottom. The pattern repeats across market cycles, and it's one of the clearest ways that emotional, headline-driven decisions erode returns over time. Rebalancing on a schedule, rather than chasing trends, is one way investors try to counteract this pattern. Fourth is not having a written plan. Investors without a defined asset allocation, meaning a clear target mix of stocks, bonds, and other assets, tend to make more reactive decisions. Without something written down to check against, it's easy to let short-term news or market noise drive portfolio changes that weren't part of any real strategy. Having a plan doesn't mean never adjusting it. It means adjustments are deliberate, tied to your goals and time horizon, rather than a reaction to whatever happened this week. Even a simple one-page plan, reviewed once or twice a year, can reduce a lot of reactive decision-making. Fifth, and often overlooked, is a mismatch between your time horizon and how your money is invested. This is what happens when money that might be needed in the near term for a home down payment, a medical expense, anything time-sensitive, is sitting in the same risk-heavy investments meant for decades-long goals like retirement. Without a separate cash reserve, an unexpected need for money can force you to sell investments at exactly the wrong time, turning a paper loss into a real locked-in one. Keeping a separate emergency fund, often 3 to 6 months of expenses, is the most common way to prevent this mismatch. Put these 5 together and you get what researchers call the behavior gap, the difference between the returns an investment actually produces and the returns investors actually receive. It's not usually about picking the wrong stock or fund. It's about when money moves in and out and why. None of this is financial advice, and it's not about any specific stock or fund. It's general, educational information. Always do your own research and consider talking with a licensed financial professional about your own situation before making investment decisions.